Level 1. Beginner investor. You open an investment account for the first time. The screen looks simple. Buy, sell, numbers moving up and down. None of it feels simple. You deposit $500. Not a large amount, but enough that it matters. You scroll through stocks, companies you recognize, names you have seen your entire life. And for the first time it hits you. You are not just buying a price. You are buying a small piece of something real. You make your first investment not to trade it, to hold it, to see what happens over time. You start paying attention differently, not just to prices, but to what the company actually does, how it makes money, why people buy from it, why it grows or does not. You read more, different opinions. Some people are trying to predict the next move. Others are trying to understand the business underneath the price. That gap becomes your first real decision. What kind of investor do you want to be? At this level, your returns are almost irrelevant. What matters is learning how markets behave, how ownership compounds, how staying in position is itself a strategy. And once that idea clicks, something shifts. You stop watching every movement. You start thinking in years, and that is when you move to the next level. Level 2. Retail investor. You invest every month, not when the market feels good, not when prices are rising. Every single month, whatever your budget allows. You set up automatic contributions. From there, you allocate deliberately. Index funds tracking the S&P 500. A few ETFs focused on specific sectors. A small position in individual stocks you have actually researched. Your portfolio takes shape, not randomly, but by design. Then the market drops, not 1 or 2%. Sometimes 10, sometimes more. You do not sell. Because you understand something now that most people never learn. Volatility is not risk. Selling at the wrong time is. You keep investing through the drop, month after month. This is dollar cost averaging, not trying to time the market, but building exposure to it steadily regardless of conditions. Your returns are still modest, but your behavior is no longer random, it is structured. You think in years now, not days. Because at this level the goal is not to beat the market, it is to stay invested long enough to benefit from it. Level 3. Consistent investor. Your portfolio crosses $100,000, and that number changes how everything feels. A 1% move is no longer abstract, it is $1,000. A strong year can add $8,000 to $12,000 without you contributing a single dollar extra. For the first time, compounding feels real. Your strategy becomes more defined. You set a target allocation, 70% equities, 20% fixed income, 10% cash, and you maintain it. Not based on how you feel, based on your plan. You rebalance regularly. If equities grow too large, you trim. If they fall, you add. The decision is mechanical, not emotional. Market corrections stop feeling like emergencies. They feel like part of the process. Because at this level you understand that the process is the strategy. Consistency over time is what separates investors who build wealth from investors who only talk about it. Level 4. Advanced investor. Your portfolio crosses $250,000, and small percentage improvements start to mean serious money. A 2% increase in annual returns is no longer minor. It can represent $5,000 to $20,000 in additional gains per year. You move beyond basic allocation. You begin optimizing, adjusting exposure across asset classes based on risk tolerance, time horizon, and market conditions. You add structure through fixed income, real estate, or alternative assets alongside your equity core. Tax efficiency becomes a priority. You place high turnover investments inside tax-advantaged accounts. You use tax loss harvesting to offset gains where possible. You stop thinking only about returns and start thinking about after-tax returns, because that is the number that actually matters. The question you ask about every investment changes. It is no longer how much can I make. It becomes, what is the probability of loss, and how large could it be? At this level, you are not just building wealth. You are building a system that protects and grows it across different market environments. Level 5. High net worth investor. Your investable assets cross $1 million, and the financial system begins treating you differently. Doors open that were previously closed. Not because the investments changed, because your capital now qualifies you to access them. Private equity funds, venture capital deals, real estate syndications. These are not traded on public exchanges. They are introduced through networks, advisors, and financial institutions that do not interact with smaller portfolios. The structure is different. These investments carry larger minimums, longer holding periods, and far less liquidity. Your capital may be locked for 5 to 10 years. Returns are distributed over time, not immediately available. In exchange, the potential upside is higher. So is the risk. You begin working with private bankers, tax specialists, and advisors, not to replace your judgment, but to structure your capital more efficiently across a more complex portfolio. The challenge at this level is no longer access. It is selection, because once your capital reaches this scale, opportunities stop needing to be found. They start being presented to you. Level 6. Professional investor. Your capital crosses $10 million. And investing is no longer something you do on the side. It becomes your primary function. A 5% return is no longer just a percentage. It represents $500,000 to $5 million in annual movement. Every decision carries weight. Your portfolio is now deliberately structured across multiple asset classes: public equities for growth, private equity for long-term upside, real estate for income, fixed income for stability. Each allocation serves a specific purpose within a larger system. You may begin operating through a formal structure, a family office or investment entity, to manage taxes, reporting, and capital deployment more efficiently. Performance becomes measurable against benchmarks. You track internal rate of return across private investments. You evaluate whether your capital is actually being deployed effectively or just sitting in comfortable but underperforming positions. At this level, avoiding major losses becomes as important as generating returns, because large drawdowns are harder to recover from at scale. One catastrophic year can undo years of careful compounding. Your identity shifts. You no longer think of yourself as an individual investor. You operate like a portfolio manager. Level 7. Institutional investor. Your capital moves beyond personal scale. You are now allocating hundreds of millions, sometimes billions, through a fund, a family office, or an institutional structure. You no longer focus on individual securities. You focus on allocation decisions at the highest level. How much capital flows into equities? How much into private markets? How much into credit, real estate, or alternative strategies? You invest through managers as much as you invest directly. Hedge funds, private equity firms, venture capital funds. You evaluate them on track record, strategy quality, and whether their incentives are genuinely aligned with yours. Liquidity becomes a strategic constraint. You cannot move large capital quickly without affecting pricing or access. Decisions are planned across quarters, sometimes years, and your capital begins to influence outcomes. Large allocations can support companies, shape sectors, and validate entire strategies. When you commit, others follow. At this level, investing is no longer about selecting assets. It is about directing capital at scale. Because capital this large does not just participate in markets, it begins to shape them. Level 8. Billionaire investor. Your net worth crosses $1 billion. And scale changes everything about how you operate. A typical investment is no longer a few million. It is hundreds of millions deployed into a single company, a single idea, a single strategic position. You are not buying shares. You are taking ownership, sometimes control. Public markets are still relevant, but they are no longer your primary arena. Private markets dominate. Direct deals, co-investments, large capital placements negotiated entirely outside of public exchanges. Your decisions carry visible weight. When you take a position, markets react. When you exit, it is noticed. You cannot move quietly at this scale, so you move deliberately. Liquidity is no longer a given. Entering or exiting a major position requires planning, timing, and coordination that smaller investors never have to consider. Opportunities at this level are never public. They are structured, negotiated, and executed privately between people operating at the same scale. And here is what changes most fundamentally at this level. Investing is no longer purely about returns. It is about influence, which companies grow, which industries expand, which ideas receive capital and therefore have a chance to survive. At every level below this one, you are reacting to the market. At this level, the market reacts to you.